Welcome to PlanStrongerTV. I'm your host, David Holland. Do you have life insurance? Do you need more? Do you need less? What type do you need? There are many questions surrounding life insurance. On today's program, I'm joined by Dan Slater, an insurance actuary who will give us the inside scoop on life insurance. Of course, I'll chip in my 2 cents on the subject, and I'll answer your viewer questions. Let's roll. Welcome back. Glad you're with us today. We're going to talk more about insurance. No, don't change the channel. This is important stuff. I'm very glad to bring Dan Slater back to us and meet with us here in our studios in Daytona Beach, Florida. And Dan, thanks for making the trip again.
Love it. Thank you, David.
All right, Mr. Dan Slater, he is with Core Income Advisors, a firm that he started, and he works with advisors all over the country, right? Helping them with their insurance needs and how to make recommendations to their clients.
Yeah, how to work through the very complex nature of what insurance can be and all the different types and products and companies, and being able to offer that to firms like yourself and other agents around the country. So.
All right. Hopefully people didn't change the channel. No, this is an important part of our social and financial fabric for our country. If we don't have insurance, I've told people this before, if we didn't have insurance and the ability to transfer risk, there would be castles and fiefdoms, because the only way that things would be able to be done is if you had an incredible amount of personal or financial resources to be able to make something happen, because you wouldn't be able, for example, to drive a car.
Right.
I mean, you wouldn't be able to have things, and you certainly couldn't have the capitalist society that we have,
right,
as diverse and widespread. So anyway, I'm glad you're here, because I want to dig into this and talk about why this is so important. So one of the things that's really great about Dan is he is an actuary, and so that actuarial experience you have, Dan, is working for an insurance company in the past. You've seen this from the inside out.
Right, right.
So that's very helpful. So what I wanted to get into today, and this is a special request from the crew here at WDSC, that we talk about life insurance. So one for the crew, but one for you too, ladies and gentlemen, because I think it's a very important subject. Life insurance.
Yeah.
It's been around for hundreds of years.
Yes.
Right? I think some of the first policies were done, I don't know how long ago, but at least 400 or 500 years ago?
Definitely.
Okay. So there's so many things we could talk about. From your perspective, what are some of the most important things for the consumer to know about life insurance?
Right. Yeah. Life insurance opens such a broad topic.
And it's a 30-minute show, not 3 hours.
Yeah, exactly. And that's kind of what leads to a lot of confusion, is just the different types of life insurance. I think that's where it's obviously very important to work with an advisor that understands those mechanics of, what is life insurance there for? If step back just from insurance, I always start with the basic fundamental that insurance is about leverage on your money. Because like you said, if I wanted to insure my home and my home was $400,000, but I had to insure it, well, I'd have to have $400,000 sitting there to do that. But when I buy an insurance policy, I'm able to get leverage on my money, so I can pay, a couple $1,000s a year, and if that event occurred for me, I would get that leverage on my money. Okay. So that's just the basic nature of insurance. When you get specifically to life insurance, that's, obviously having to do with how long you live, or if that event happens in reverse, if you end up passing away sooner than expected. So what you'll see is the most common form of life insurance is really term insurance. Okay. This is something where you're looking to protect your income or maybe debt that you have. I always, most common right when you come out of college, and we got, my wife and I got married within a year, and I have X amount of student loans. Right. If something happened to me, she would have to take those student loans. So what you can do is buy a policy. Maybe it lasts for 10 years, the time I'm going to be paying that insurance down, or the student loan down, that if something happened, she would be able to take that money, pay off the student loans, and have protection. Okay. That can also help protect income.
Right.
You know, if you have a primary wage earner and, you know, going through your working years, you're trying to protect against income or income replacement.
That person is a financial engine.
Yes.
And so if that engine breaks down or goes kaput, we need to replace that financial engine so that life insurance coming in at that moment, that creates a financial asset that then can replace and produce income for what the wage earner was providing.
Right, yeah, some people just automatically think I need to buy some insurance. You know, again,
Right.
stepping back, what is my purpose for buying that
Right.
insurance? Like you said, that financial engine is a very important component.
Okay, so there is term insurance where you pay a premium each year. If you die within the period of time, coverage is provided, death benefit comes in.
Yep.
If you don't, then you don't have anything after that 10-year period.
Correct.
Now,
Correct.
when we talk about having term for 10, 15, 20 years, we're talking about the period of time where the premium is level.
Right.
After the 10-year period, you could keep it,
Right.
but it goes from, say, $500 a year to $5,000 a year.
Yeah.
Some number where the insurance company has put that premium after the initial term at a point where
It's a barrier.
actuarially
Yes.
we know that they're not going to keep the policy.
Right.
Okay.
Yep.
So if somebody's need is longer than that 10-year period, okay, then do we need to look at either a longer term policy? I want a policy for 15, 20, 30 years,
Right.
or do I need to look at some sort of permanent form of insurance?
Policy, right. And again, that may vary depending on what type of career you have, what, you know, always what's your human capital
What your
versus your
obligations are.
financial capital. Right, exactly. You know, kids start going to college, all these things change. One important way to answer that question as well is not so much on the income replacement side, but think of yourself when you buy life insurance, you go through an underwriting process.
Right.
You know, and fortunately, I could say I was a few pounds lighter, you know, back in my 20s coming out of
Weren't we all?
college.
Weren't we all?
You know, maybe the blood pressure or cholesterol, the food things to change. So, you know, you kind of always want to buy as much of that insurance you can when you're most fit to do it. So, you know, you get the best price.
Because once you've got it,
Yeah.
it's based on your health at that time. You don't have
Right.
to re-up or reevaluate unless you're looking at a new policy.
Right, exactly. So that could be a very important decision-making process that if, you know, you're 30 and you buy a 30-year policy, well, that's going to take you to 60. That's probably through most of your wage earning years. Now, it does go more expensive because it's guaranteed for 30 years versus 10.
A 30-year level premium policy will cost more than a 10-year.
Yes.
Because the insurance company their obligation now is going to be for that 30-year period, and there's a good chance you're going to keep it.
Right.
Okay.
Right. Versus I buy a 10-year policy and now I have to re-underwrite. 10 years later, maybe something's changed in my health condition,
Okay.
which is kind of where the evolution of the permanent policy has come into play, meaning I buy a policy today and I own it for the rest of my life. So you actually never go through an underwriting process again. Now, at that point, the insurance company also knows that risk has changed.
Right.
Because in a term policy, a lot of people will pay the premium and they never have to pay out that claim.
Right.
You know? But on a permanent policy, the insurance company knows they will pay a claim on everybody,
That's a good point.
whether it's 10 years from now, 30 years, or maybe 70 years from now.
Yeah.
At some point, everybody will receive something back. So again, when you start to look at the cost of a policy like that, you know, you're going to start to see a significantly higher cost. Now, what goes along with that, so this is kind of where the actuaries start to brainstorm and think
Right.
of, well, what can I do if you're going to own this thing forever?
Right.
You know, well, what if I made it look better and made it a little richer from the standpoint that it accumulates money or it accumulates gains in
How
the
can I
contract?
make it more competitive than my competitor's product?
Yes, exactly. Because in the term policy, like you said, if you go through it and you die, there's no value. There's no cash value to it, so it just is what it is. But a permanent policy is going to have some accumulation of growth in there. And I think that's definitely a debated topic many times
yeah.
you know, buy the term policy, keep the premium real low and invest the money, or do it within the same policy. I'm not going to say either's right or wrong. I think it's very dependent by how that fits in your plan. I always say, again, what was the primary purpose of what it was doing? You know, and so if it's income replacement, do you need that insurance policy from age 60 to age 100?
Right.
You know, or what is the cost of that cash value down the road? You know, that's where working with an advisor has to come into play, because that's not easy numbers to crunch.
No, it's not. And it's also, you already spoke to this, and I want to echo the point or kind of build on it, is that you may have multiple purposes with this policy. You know, it might be primary focus might be on life insurance, but it might have these additional benefits that really can come into play, and so these policies can pull double duty.
Yeah, they have double duty purposes, double duty assets. You know, and this is an important thing because life insurance has changed significantly through evolution and innovation. You know, if you have insurance policies that you've bought 5 years ago or 10 years ago, or, you know, I see them because we work with advisors, policies bought 30 years ago. And, you know, you wonder, you have to assess, is that still the right policy? You know, I bought that permanent policy, it's grown, it's accumulated money. Well, if I don't need that insurance protection anymore, is there a smarter way or better product for my new financial position?
That's great, Dan. Yeah, that actually is an excellent way of looking at these policies. You, for example, might have a life insurance policy that has cash value. You no longer really need the life insurance because you're at retirement age for replacing, you know, the income or paying off a debt because you've already done that.
Right.
Maybe, though, what you really need is long-term care.
Right.
So you might take this policy, the cash in it, get a new policy that still might have some life insurance benefits but can take care of long-term care. Isn't that a smart thing to do, to make that, you know, kind of reevaluate?
Yeah, reevaluate what is your risk and what asset do I have to cover that risk. So again, the need of that policy has changed over time. You know, at that point, yeah, you're going to be buying a new policy. So as we talked about, you'd have to re-go through that underwriting process, but it'd be different because you're not buying big amounts of life insurance coverage. You're buying, you know, mobility and cognitive impairment insurance, things like that. So that's always in discussion with the advisor, what makes the most sense. At some point, maybe some people may make it a pure estate transfer.
True.
Meaning, I don't need this insurance really for our life anymore, but I'd love to be able to put money aside for my kids and their grandkids. And again, maybe I want to stop paying the premium. You know, you're 60 and you're still paying a premium to your life insurance policy. You know, could you be using your money more efficient for, you know, getting ready to retire?
Yeah, so you might take that existing policy, transfer it in, basically do a one and done premium.
Yep.
And then it's going to be some sort of guarantee type of policy, where there's or at least a policy there's a good chance it's going to provide that death benefit.
Yes.
And you don't really even need for it to have cash value because you don't need that. Then you can have it be really part of your legacy.
Right.
Tax-free, of course,
Absolutely.
also.
And that's the ultimate true benefits of life insurance, is that leverage potential, but also, you know, the IRS has made that a tax-efficient asset. So, you know, those proceeds do go to beneficiaries on a tax-free basis. And it doesn't always just have to be, you know, spouse or kids. There's charities.
Could be anybody you want.
Yeah, you can split those up in any increments you want. You can change that over time. They're going to get that tax-free benefit of it. And like you said, if you converted it today, that may just be a fully paid up policy that no matter what happens in the future, that money's going to get passed on.
I think a lot of people like that about the ability to have that kind of insurance. The other thing I want to make sure we talk about, Dan, is the consumer, the people watching this program, they hear and see a lot of different information.
Right.
About life insurance or different types of insurance and different companies and different types of policies. And let's be honest, you know, the insurance, financial industry in general, there can be a lot of spin, a lot of propaganda. You know, one person or company will say, buy this, and other ones will say the exact opposite.
Right.
So what does a consumer do? I mean, how do they have all this information coming in, and then they're supposed to make a decision about what's best?
Right. Yeah, that's not an easy task.
Right.
And yeah, TV commercials, you know, who's got the new coolest commercial and so on. And I know your firm is this way, but that's the type of advisors we work with, is what breadth or shelf do you have for insurance carriers that you're offering? You know, do you tend to only sell one carrier? Some people only represent one company.
Well, because they're employed by that company.
Right. So you probably have a good idea what the answer is going to be. Again, just different ways in which you can access that money. But I think as a consumer, that's an easy question to ask is, well, how does this compare to other companies? And even if it's in the same product line, meaning term versus term, well, I still want to know what that looks like amongst 3 or 4 companies. Or if I believe whole life is the way to go, I don't want just one company's whole life. I want to see 3 or 4. And if your advisor can't do that, I don't know if they have enough, in-depth nature to know to answer that question for a consumer.
Yeah, and I think the other thing to kind of put with that, and this is something that is sometimes hard for us to get our minds around when it comes to something that often we don't even want to pay for to begin with, and that is cheaper is not always better.
Right.
You use the example of term insurance, and I've made recommendations to clients saying, okay, here are 4 different term companies that we think are, the highest rated. They've been around for a long time, but we might have one company that's, 5% cheaper or one that's 5% more expensive, and we may ultimately look to the one that is a little more cost-wise because of either, the strength of the company, their ratings, how long they've been in business, and quite candidly, my confidence in that company and their management.
Yeah.
There's value in feeling confident about that company being there long-term for the client.
Well, and I think, especially from a consumer standpoint, it's something you wouldn't necessarily know, but even like customer service.
Oh, yeah.
How does that interaction work if you have a loved one that has to claim a policy? Are they getting voicemail when they call in? And that's an experience that you would have more familiar, or myself, because this is kind of what we do all day, every day.
Dealing with it all the time.
One of the important things, and I don't want to dive too deep with this, but like in term insurance now, maybe for an additional little bit of premium, some of those products now allow you to convert that to a term policy.
Right.
So everything you've spent in that term policy, you don't have to, but you could use that to move into a permanent policy. So, that's kind of the innovations where, you can buy them separate, or there's certain pieces you pay a little bit more, and that's always a trade-off. How much more to buy that option that I may or may not use in the future.
Options are always important.
Yeah, definitely. Well, and that's a big thing we see today. Like you mentioned, the ability for a long-term care benefit or living benefits. Those didn't exist even probably 6-7 years ago, and maybe a great opportunity to provide accelerating that death benefit while you're alive and being able to pay for care. Because again, you're going to have to use some other asset if that is your primary source of passing on your legacy.
Good, very good. Very helpful information, Dan.
Thank you.
All right, well, thanks for being with us again. Dan Slater, ladies and gentlemen. Good to have you.
Great, good topic on life insurance, David.
Absolutely. Okay, it's time for the viewer question segment of the show. And it just so happens I have a question to answer about life insurance. What are the odds? Okay, our question today comes from Luke. Not long ago, he came in to meet with me for a second opinion. He told me that he had a 401k through his job, but he was unsure if it was the best place for his money. Luke also wanted to know what I thought about a life insurance investment plan that had been pitched to him by a local insurance agent. Many people have questions like Luke, so I'm going to go into some detail on the subject, but I'm going to break it up. Ready? Part 1. The first question I asked Luke, which would apply to many people who are still working, is does your employer offer a 401k or similar plan where you can invest through payroll deductions? If so, please make the most of it. Luke was putting $30 each paycheck into his employer's plan. Depending on the limit that applies each year, an employee can sock away quite a bit into a retirement plan at work. For example, in 2017, the employee contribution limit was $18,000 for most plans. If you are age 50 or older, you're permitted to make an additional catch-up contribution of $6,000. I told Luke that he shouldn't invest any of his money in any other plans until he had made the maximum contribution permitted by his employer. The potential for pre-tax compound growth is hard to beat. I recommend putting aside at least what your employer will match and then increase your contribution as you can. Let's assume you put away $150 a month for 10 years and you earn an average of 7% after fees and expenses. After 10 years, you'd have $26,000. After 10 more, it'd be about $78,000. If you were able to jack up your contribution to the 2017 annual max of $18,000, the amount saved would soar to a total of $260,000 in 10 years. Add 10 more years, $781,000. Wow. Of course, each of us need to find the level of contribution that fits our personal circumstances. Now, there are some caveats. I'm not suggesting that people put money into a retirement plan that is needed for living expenses. Before getting aggressive about your contributions, I strongly recommend you get the rest of your financial house in order. Build up a cash emergency fund, pay off any high interest rate debt, and get adequate health insurance and long-term care insurance if you're over 50. Now, for part 2, Luke was unsure about which investments to choose in his employer's 401k plan. Under federal guidelines, employers offering such plans are obligated to make a variety of investment choices available. That usually means there are 10, 20, or more choices available within a plan. From my perspective, the more choices, the better. But too many can be overwhelming. This is where the financial advisor for the plan is supposed to help by offering group education meeting and possibly individualized guidance. Of course, the amount and quality of advice from a plan's advisor may vary substantially or not even be available. Some plans offer online resources where a robot will tell you which investment funds are right for you. For those looking for more personalized advice, however, you might need a human advisor who can help you find the right solution and choices for you. You can pay an advisor by the hour as needed, or pay them a percentage to manage your account on an ongoing basis. With proper arrangements and safeguards in place, your advisor can access your retirement account and manage it for you, including setting up the appropriate strategy and selecting your investment funds. Why should you go to the trouble and the expense? Aside from home equity, retirement accounts are often one of the largest assets for American workers and sources of income for retirees. If you can't get good advice at work, find and pay for good advice yourself. The size of your retirement nest egg could depend on it. Now, for part 3 of Luke's story. When he came to see me, he had been weighing his retirement saving options against the life insurance investment plan recommended by the local agent. Before I get into my second opinion, let me first give you a couple of cautions from history. History lesson number 1. Besides ensuring a person whose death would financially impact others, life insurance has also been promoted as a way to minimize taxes, build up cash value, produce retirement income, and even shield assets from creditors. Unfortunately, at times, overzealous product creativity has resulted in financial hardships and even lawsuits. In the 1980s, some universal life policies were sold to consumers with projected interest rates as high as 14%. Other policyholders were told that their premiums would vanish at some point while the policy remained in force indefinitely. Large cash buildups were also projected inside these policies and touted as a future source of tax-free income. To the contrary, when prevailing interest rates fell, the premiums did not stop, and in many cases, it was those large, tantalizing cash surpluses that vanished. History lesson number 2. Variable universal life policies became popular in the 1990s. Instead of a fixed rate, policy owners were investing their money in sub-accounts, kind of like mutual funds. Given the stock market's strong performance at the time, lofty 12% annual returns were often shown, supporting the death benefits, the required premium, and those projected cash values. When the stock market fell nearly 50% from 2000 to 2002, life insurance companies asked for more premiums. Policies blew up, benefits were lost, you get the idea. Today, index life is the latest innovation. It links policy interest to performance of a stock market index, such as the S&P 500, without putting policy cash values at risk. It's definitely not a bad idea to have a trade-off of getting part of the market's gain as interest with none of the loss. However, this new life insurance product is now being illustrated with eerily similar predictions of generous retirement income and bulging cash values. Here again, these attractive outcomes depend heavily on robust projections of future returns. This index annuity policy is the product Luke had been shown by the agent. So what was my answer for Luke, for his situation? I told him not to buy the policy. Here he was putting $30 a week into his 401k, and the insurance agent was pitching him on a life insurance policy as an investment. The truth is, Luke didn't need the insurance. He wasn't even married and didn't have any kids. So you can imagine I told him, look, we don't need to get the life insurance. You need to get serious about ramping up your 401k contributions. Listen, I appreciate the opportunity to share with you this story. reevaluate if you've been presented something you're not sure about, and if you do that, you will plan stronger. Thanks for being with me.
If you would like more information about the topics and our guests featured in this series, please visit our website at PlanStrongerTV.com. Also, if you have a question you would like David to answer, please send it to questions@PlanStrongerTV.com.